This video is a follow-up, and we are going into detail as to how we can use the RSI to determine either whether a stock has the possibility of turning around and is due for a pullback. And in the previous video we had talked about uniformity, and that we take the trade when we see uniform action in the RSI or some type of symmetry. Now, the more clearly defined the symmetry, the more clearly defined the RSI support with uniform action, the more the trade is there to be taken. Now, you're going to observe that there are many instances where uniformity is not clear, and if it's not clear and it's confusing, don't take the trade. So we'll take a look at some random stocks to see how we can go deeper into deciding whether a trade is good to take or whether a trade is not going to work out. Alright, let's take a look here at the first one, PRTA. We can see that the stock had a massive run all the way here from about $4, $5, and went all the way to trade as high as 47, 48 in close to 1 year. So that's a massive move. So we know that the RSI move began here. So we draw a simple straight line, and you can see that even though generally speaking the RSI held at this point, it really did not have uniform action per se. Now you can drill it down. For example, this period there was no uniform action, which corresponds with this level here, and there was no major bounce. You know, this was not as bad, but it wasn't uniform activity either. So we can see that as of that point you cannot use uniformity on the bounce because there's no uniform action. And you can actually see that there was a slight, eventually a move below that green line and back above it, which corresponds with this entry for a slight move higher. And then we have another V-type formation on the line for another slight move higher. And since then the stock has moved from about $18 to close to $30. Yes, so you can say that on hindsight, even though I don't think it was a trade that should have been taken because we had failed to see the initial uniformity at that point, we had failed to see uniformity here, so the trade was not there. So even though we can see, just for the sake of education, that down the road it's only after the stock had 2 bounces with uniform activity that we start getting some traction to the upside. So in this particular example, I would say this is a case of non-uniformity, even though we can see that from a visual understanding, eventually the moves that had some success did show uniformity on the same line that had begun the move sometime early in 2013. So this is a case of where uniformity did not work. There was no need to take the trade. Just want to point out something here. We can see that this move, this massive move, eventually broke with the RSI breaking right there. So that break in the RSI here is what brought the stock off the highs, I would say somewhere around here. And so 2 observations. If you extend the same line, you see it comes in contact with that high point with uniform action. Very nice, which gave you that high in the 40s. Since then, stock has not been back up to that level. So that's one view. There's also another view, which is draw a simple straight line like that. And you can see that the same line also gave you the high, that break point, which is that point there. So all this indicate at this particular time you would have used the uniform activity not to find a stock to buy, but to find a stock that either you could go short or to avoid. Okay, we can see that it's come back to that same point here in the current market. So over time, on a week-to-week basis, depending on what happens here, if we end up having uniform activity, then somewhere around here is the high. You can take a short trade. The next one on the list is PRTS, and we see that there was a nice move above the prior highs. Just find where the move began. You can draw it this way. This corresponds with this entry, which took the stock from $1 initially all the way to about $3. So even that was a good move. Eventually it would go to trade as high as $4. So we take our line extension, and on this particular instant we can see that it had come close to uniform action here, close enough for a slight multi-week rally, but not the strongest. So I guess what I want to show you here is that it's not that always you're going to get that move, but at the very least, on hindsight, you did not lose money doing this trade from about 240, 250 all the way to about 320. So not the biggest mover, and eventually it's when it came down here and settled on the line and there was no uniform action. Let me draw that again. So draw that line again like that. You know, in a way you can use this as uniform action, but in terms of what we were looking at, you want it to be a very clearly defined turnaround situation with uniform action. So this is a case of non-uniformity also, in my opinion, but we can also see it was successful, has been successful since then. The stock has moved from about 220 all the way to again back to 3.2. So obviously this is where the recent move began. I would argue it's not uniform, but then again one can make the argument it did settle at the line, so meaning that the stock was respecting the same level. So depending on how you want to look at it, we can use this as an example of non-uniformity, or at the same time it could be an example of uniformity. Now let's take a look at an odd example. This is just for the sake of visual analysis. There was a move in the stock right there. That move there was responsible for a move that began in the, this is a micro penny stock. I mean, we are talking penny stocks, not even penny, micro. Low price, but the principle is the same. We saw the stock move here from here and quadrupled in price. We extend that same line of entry. I guess just extend it out, and we can see that either this was uniformity. I would say that was uniformity because it moves below the line, back above it with very uniform action at that point. Not the most decisive, obvious uniformity, but yes, it was uniform, which took it again from under, is that, how do you even say that, 0.10 all the way back to 0.3. 0.03, so 3 times the money. So we see that uniformity did play a role in getting this low before this spike in price. Now I want to go backwards to test whether this line was also legit. If we go backwards to see whether it makes sense, we can see that in going backwards on the same line here, so let me change colors. We see that this period here there was no uniformity, which explains why the stock was not moving higher there. There is no uniformity here, which gave a slight move higher. So not to confuse you, but sometimes the best way to test a line is to go backwards to test the previous entry, and here we go backwards just to test it. We can see that there was no uniformity here as a support. And if you've been watching the same series of videos that you're watching, then this would make sense. If this is the first video you're watching, I would suggest go back and check the prior videos on the same playlist, and they should explain this backtest theory. So there was no bounce here because there was no uniformity. Again, we see an example and I'll admit it's not the best, but it shows you that where there is no uniformity, do not take the trade. All right, let's take a look at another idea, STLD, and we are taking a look at this slight move above that wedge. So there was a wedge there, and that gives us the entry level. That was good enough to take the stock from under 18 all the way to about 25. Not the biggest mover, but we can still use this as an example. We see that we come and we can now draw a straight line, and that straight line is around the 50, slightly above it, somewhere there. We see we have one instant of uniform activity support at the 50, which was good to hold the stock from under 20 all the way to about 23. Again, not the biggest moving buy signal, but you didn't lose money. We come back again and test that same line around the 50, and there is no uniform action, so you cannot take the trade even if for a slight direction or move higher. So during this break, there was no support, no uniform action here. Don't take the trade. So again, here is an example of non-uniformity on the RSI, so don't take the trade. In fact, you can even see now that seems like the stock is showing resistance, as we can see here. So the same line, apparently as of right now, the market is showing resistance, which might explain why the stock is not moving higher past that $20 level. But here what I want to show you is that the lack of uniformity at this point meant don't take the trade because there's no bounce in store. Let's take a look at a long-term monthly view for Home Depot. So this is between 1990 and 2015, and we want to capture this great move here from about under $10 all the way to about $54. So that's a very big move in a couple of years. We can see that the move began during this RSI breakout somewhere there. It is this breakout there that began that nice move. So we draw a simple straight line. We see that we came here in 2000 and there was no uniformity bounce, which means do not buy the bounce, because that was showing no support. In fact, it sliced through that line, which means a sell signal, so you would have avoided buying the stock during this drop. We come here eventually and we seem to be always finding resistance on the same line, and eventually the stock does. Over time, there's also a slight high there which corresponds with coming close there. In other words, the same line became resistance during these highs, and eventually the stock would roll over. We come and see uniform activity above the same line and back below it, which surprisingly gave you a short-term high, and eventually we move above the line. So now remember, we are doing this on hindsight. We are trying to study what stocks do around their RSI. We went above the green line, which is this entry. We went around it with uniform activity, which was a sell signal at that point. Let's be frank. And then finally we see this V-type uniform action, which was an entry, a well-defined V-type formation. So let me take that off, and this line that I was drawing comes from this high. So something like that. You can see that this is uniform action below the line, back above it. So the same line again was being used by the same stock. This began the biggest move. We can see that there are two big moves on this chart. We're talking about 25 years of data. This move began exactly at that level. We see again that this move, massive, began precisely at this RSI level. So that uniformity was being respected by the same stock even about 12 years, 14 years down the road during this uniformity level. So it's interesting how that plays out, that the markets tend to have the same type of RSI level beginning a move that began the same or the biggest move in the stock prior to that, going back many years. So I think that's very interesting and actually makes this method we are talking about of uniform activity around the RSI critical levels, it gives it some type of legitimacy, because if markets can do that 14 years down the road, then that means that that method we are using here is actually correct. All right, so we see there was another slight move here, and take note, this was a very slight move, not the most successful. Remember, we are trying to find the biggest moving areas in a stock and figure out how we can use the RSI level for an entry. So we can see this is a slight move here from about $15 to $35. You know, I would say it's not a bad move. It's 100% gain. But we can see that the move began during this slight RSI move. So there's a RSI out of this level. Draw a simple straight line like that. And we can see that we continued making lower lows during that crash of 2008. And the RSI, even though the RSI was finding uniform bounce support on the line, it was not very strong. And so here you see an example where the RSI was doing its best to hold, and yes, we can see that it held, the RSI held, the price did not. And it's only after this lower lows in price and the RSI making a stand on the line that eventually we launch another move to the upside. So here's an example where uniformity did not work, was not as successful immediately. There is actually a lot of data on this chart. Let me show you another example here of how we can use the RSI and uniformity. So a couple of things. Let's take this break in 2000, which corresponds with a high. And we know that down the road, if we break below that with uniform activity, that is a sell signal. Somewhere, let's make sure I got that right. Let's draw it somewhere there, around 69.1 would be where my guess would be. You can see that eventually we come back to that level here, beginning of 2015, but there is no uniform action. So you can't short the stock because it has come back to a prior resistance line. You don't get any uniform action there. In fact, you get the RSI moving above 69.1. You get the RSI making a fast or a new breakout above 3 to 3 year highs. So a move to 3 year highs in the RSI. Here was not only a very strong signal of momentum, you can see that eventually it moves back above 69.1, and I explained this on my YouTube videos, and you can see that after moving above 69.1, you can see this nice move from 35 to where it's trading here in the 110s. So there was no uniform action at this point. Let me draw that line again. That break, you can always leave that on your charts, and you can see that we did not get any uniform resistance here. In fact, it's sliced through it, and that became a good buy signal if you are looking to go short, because the RSI was coming back to a critical level there. That critical level is what began the slide in 2000. Expecting to see uniformity, there was none. So because there was no uniformity, then the trade is not to be taken on the short side. In fact, it turned out to be the best thing to have done was take the long side, which is to go long, because failure of uniformity to show you resistance means that the opposite is happening and you're going to get a rally. Also, let's just take that in mind, that based on our RSI breakout principle, we had the RSI breaking out to close to 12-year highs. So close to 12-year highs, very nice entry there. That's one of our minimum requirements, which was also with a price breakout. Very nice price breakout above this resistance band. Very nice entry there. And we can also see that at the beginning of 2015, we have both MACDs making at least a 3-year high. So here, at least 3-year highs on the MACD, and also here, at least a 3-year high on the MACD. In fact, this was a multi-year breakout. So when Home Depot was beginning to move at that point, it was clear, if you use the principles, the ultimate more the breakout, that the stock was going to have an opportunity of having a massive move, and that is exactly what happened. Now let's take a look at another data point on this chart, which is this break in the RSI, which gave you this break in price for a move that took the stock from $30 all the way to about 15. So that's a 50% correction. And so after finding this break point, which again happens to be around the 50 on the monthly, draw a simple straight line, and you know that if the stock had come here with uniform activity and showed resistance, then that was a sell signal. But you can see what happened on hindsight is that the stock did go above the 50, below the 50, and then again back above the 50. Looks something like this. So looks something like that. It went above it, below it, and above it, both of them being uniform activity here. And eventually that was good enough to take the stock from this. So we're talking about this period. Since then the stock has been higher. The reasoning here is that it held above the red line, which was a previous break, and since then actually did go on to use the 50 as support here, which gave you those lows, and again it came close here with uniform activity, which gave you those lows. So what I'm trying to get at here is the same chart can give you lots of data points, all of them playing around with that principle of uniformity when a stock or a market or a commodity or a currency is weaving its way above or below a previously predetermined entry or a previously predetermined sell point. Let's take a look at another example, MCP on weekly chart, 4 years worth of data, 4 years, and we see that it's been down over the last 4 years from the, let's call it the 70s, now trading in the under $1 level. We can see that there was a break some point here. There was a break in the weekly RSI, which again happens to be around the 50, which was that break at this break point in the price. Now if we draw a simple line around the 50, or just keep it around the 50, we can see that the stock itself has been using the RSI for sell signals. Now this is a case of where uniformity does help you in getting out of the position, because you come back here with uniform activity and show resistance at that level, which was a major high. You come here, you show uniform activity above 50 and back below it, which is also where our red line is, which gave you those highs. You do the same thing here in what looks like this type of action. It's a double top. And so in my opinion, you can see here that this is some type of uniform activity, just like this is here. So you get another high in price. Eventually you come and make another high. You touch 50 and back below it, which were the highs beginning of 2014. You come and touch the same 50 level, which is the highs early 2014. So we see here a case where we get uniformity and symmetry making a lot of sense in telling us when the stock was going to be making potential highs. Now that I have the chart in front of us, let's observe the current market action in this one, and you can see clearly defined here was a nice break, and the break point began this move here in the $5 level, and a simple straight line like that is going to tell you, as you can see here, that more than likely, if this is the case, that the stock finally manages to form this uniformity action, then this is a short-term high. As you can see, the way it's behaving as of right now, it hasn't finished that uniformity process, but if it turns out that that is uniform action around that red line, then it definitely means that this is a sell signal. On the other hand, if it can jump above that red line and jump above this $1 price resistance, then maybe there's a move for the stock to start rebuilding after a couple of down years. Let's take a look at another example. This one is probably going to be more in the sense of giving us confirmation that the uniformity does work. It is for Southwest Airlines, and we just take a look at this nice breakout here, late 2012, off this wedge. So that entry point there began the move that took it from under, let's call it about $8, $9, all the way to the $14, $15 level. So nice move. And so we can see that the entry level was here around the 50, just slightly above the 50, and it would look something like that. You can see the market has used the same level for support here with uniform action on the RSI, uniform action below the line, uniform action below 50, uniform action above the line, uniform action also above 50 for a nice entrance there at about 12.50. Since then, the stock has gone to trade very well in the 40s. There's also another breakout level. So this breakout. So let me take that off and show you there's another breakout above this declining RSI line. And you can see that the market has used the same breakout level. Now that breakout here began this nice move during this breakout in price. So that entry is what we are talking about. Very successful entry in hindsight. So if you had missed all this move to, let's say, somewhere here to the 35 level to here, during this pullback here, you saw that the market came back to the green line and held with uniform activity. In fact, it just kissed it and bounced. So that was a nice entry here in the 30s, and the stock has gone on to gain about, let's call it about 60% since then. So you can use the same level here, and on this chart we can see clearly that this is one that shows that uniformity can be used with a lot of success. Let's take a look at another example, and we see that there was a breakout in price there, or in the RSI I was trying to say, and that breakout also corresponded with the price breakout. So price breakout there, RSI breakout here, and so we know that that began a very nice move in the stock, moving it from about $8 or under $9. And if we extend our move from there, we can see that this has been used before as a bounce area, which was those lows, for a nice move and a bounce after coming and making uniformity there. So if you are waiting for the next bounce on the stock, it came here beginning of 2015. There was no necessarily any uniform action at that point, which was this sell point. So that was not a very good, there was none, in fact, no symmetry, no uniformity bounce, and so the stock was not a buy during this point. So if you're looking for an example that shows you that you should only take a trade when there's uniform action, here's an example. Now there's an argument that I can make, and it's not a good one, but let's just make it for the sake of understanding here, that this breakout, draw a simple straight line again. So the same straight line, and you can see that this is not uniform action below the line and back above it. It's not very symmetrical, but you can actually use it if you wanted to. If you are really desperate to own the stock, and eventually after you see it come back above the line here, that's an entry level sometime in February, which is here in the $24 area, and since then the stock would go on to spike to about 32, 31. So you can actually, it's up to you to decide whether it's uniformity or not. I would say it's not, visually speaking, because it looks something like this. That's what it looks like. And so this is not uniform action, so there was no trade to be taken or to be had at that point. And yet it led to a successful bounce for a couple of weeks there, if you assume it is uniformity. So really the question is this uniform action below the line and back above it? I would say it's not, but if you did take the trade during the move back above the line, which is this entry, you at least got a chance to own the stock when it was moving up about 8 points to the upside. Now let's take a look at the same stock, VDSI, from a long-term monthly view. Stock's been having these massive moves and then a break, massive move there, another massive move here, and recently another massive move. And we can see that if we take a look at this particular breakout, just as an example here, we see that the RSI did break out of a range at that point, which was here at about 250. Stock would go on to trade in the 40s. That's a big gain. Now if you are looking for a bounce, you can see that if we extend that line like that, well, let's bring it up to here. You can see that there was no uniformity during this couple of years, none. So there was no uniformity, the stock was not a buy, and if you are looking for a reason to go long based on uniform action, there was none there, which corresponds with this price action here. Let's call it somewhere here. Corresponds with this action here, which is down. And curiously enough, it's only after the stock moves back above that line extension, the green line. So let me draw the green line extension. It's only after the stock finally moves above that green line here. I guess the green line is not showing. There you go. That the stock starts moving for a slight move, which corresponds with this entry here at about 750 all the way to about $14-15. So yes, not the biggest move, but that's almost 80% gain. Again, you see that around the green line there's no really strong uniformity action, in my opinion, which corresponds with this move here. Curiously enough, the next move also begins around after it has found support on the green line, which is somewhere here. I guess what I'm trying to say is that it's very interesting, just for the sake of observation, that the same line is relevant to the stock even years down the road. I think that's interesting because there's a nice entry here which corresponds with this beginning of a move. We break down below that line, the green line, which is some period here for a move lower. We eventually move back above the line for a slight multi-month move here, and also eventually the next biggest move in the stock was launched after it held the same green line, which is this entry somewhere here. I'm not saying you would have played that perfectly. The reason why you wouldn't have played that perfectly is because of uniformity, but if you go back to our breakout principle, you still get that it works. At this breakout here, that was a 3-year high. So you can see here, this is exactly around 34 months or 36 months breakout, which is our minimum requirement, that RSI should move to at least 3-year highs there, and also happens to be this price breakout. So even though there are other ways to look at this, there was also a breakout above the declining RSI line like that. Lots of things were going on. And if you take a look at the MACDs beginning of 2014, they were also making a move to 3-year highs, plus 3-year highs on the MACD at that point, and also 3-year highs on the MACD at that point there. So the MACDs looked good, and as you can tell, interesting that our minimum requirement for the 3-year high is always relevant and keeps you in momentum names whenever the RSI is making a 3-year high, plus one of the MACDs is also making a 3-year high. So you would have still been part of this nice move in the stock irrespective of uniformity because of that RSI minimum requirement. Now I want to go back and back test this line we've been drawing. So this line, we've drawn this line going this way. Now we are going to back test the line going backwards and this way. And you can also see that the biggest move prior was this blast above that green line, which was this movement here at about under $5, $4 area that saw the stock move in about 3-4 months to about 25. So the same green line, even in going backwards in time, was successful in keeping the stock strong. We also see a break below that green line there, gave you the reason to avoid the stock. There was no uniformity at that time, and it's only after the stock moved above the green line, which corresponds to the lows of 2003. So the same line, viewed from multiple angles, multiple viewpoints, it gives you interesting perspectives into how the stock is behaving, which actually means that the way we are looking at the RSI based on previous strong points on the RSI level, that analysis by drawing the line there gives us a lot of insight into what the stock is doing and can be helpful in finding us ideas to either own or to avoid. Let's take a look at one more example. It is TAN, the solar ETF. Now you can see there was a big plunge off these highs that kept the solar space in a bear market for a couple of years there. Now you can see that the break point of these highs there came during this RSI break. So there was a break point somewhere there. And draw a simple straight line like that. And you can see that there was uniform activity above that line and back below it, which actually gave you the nice highs in the stock here. Because of that uniform activity above the line, back below it, you got double bottom or double top resistance there, which again corresponds with the highs somewhere here in the 70s. Now what is interesting, and so bear with me as I try and explain this, is if you are trying to use the same line here for a sell signal, you can see that here the sell signal did not take place with uniform action, in my opinion. Yes it did, and yes it did not, depending on how you look at it. So it looks like this, and I'll draw it so we can explain it. You see what went on here. So we're talking about this period here, that the RSI went above it, and if you are looking for uniform activity to sell, it came back to the line and held, went above it, and eventually back below it. So you can say yes, there was uniformity because of double top uniform action, and in a way I could agree with that, because as it moved back below that line, which is this period here, it moved from about $20 back to 15. So that was a sell signal. And yet, curiously enough, very interesting in my opinion, is we have this uniform action here below the line and back above it, which generally looks something like this. So let me draw that again. So we are talking about a line that did a number like this, and I'm talking about this uniform action here, which corresponds with this uniform action here. Now, once the stock jumped above that, at that point, which is now this point on our example there, the stock did have a nice run. I mean, take a look at this move from the 20s here, or the under, let's call it the mid-teens, all the way to $50. Now keep in mind, this is a market that had been in a bear market for the longest time. So interestingly enough, that eventually uniform activity here began this nice move. Now let me take that off. I want to show you something else. Now those of us who are playing the solar space here during this breakout, we went long the solar space. Why did we go along the solar space? Because we saw a breakout here to 3-year highs. That breakout in the RSI to 3-year highs was also a push at above 61.8 roughly on the RSI for the first time in many years. So we knew that the solar space could have a chance of moving higher. The market proved that could be correct. We can also see that on the MACDs at that point. So we're talking about this breakout. The MACDs were also moving to 3-year highs there, and the main MACD was also moving to multi-year highs. So the solar space did give us a nice breakout on the MACDs and the RSI, which explains the big move in the solar space between, or for the most part, for the year 2013. Very nice move here because the RSI broke out. Now I want to keep that line extension that we've been discussing on our charts like that, and the line still is very relevant. You can see that in periods of a bull market, we had support at the line with uniform activity, which was that entry, support at the line with uniform activity, which was that entry. And now we came here and we did not see any uniform action when it came back to the line, which also coincides with the RSI break of that trend line. So lots of things going on. That break was also a move below the blue line there, which meant that was a sell signal. Why? Because there was no uniformity action. And then the market has been using the same level for resistance with uniform action there for a sell signal, which was that short-term high. Another sell signal here, which was this short-term high. And now we are back in this general area, which means that if the market shows uniform activity here, then this is also a sell signal, but you have to see it form before you take the trade. Don't just take the trade in anticipation. You want to take the trade after you see evidence of resistance. So it is very curious that one simple line, when drawn in what seems like a very confusing, volatile, squiggly-like RSI formation, one simple line starts giving you very interesting perspective into what's going on in the stock. So very curiously, that's what's going on. Another simple observation here is there was another RSI breakout. Remember, charts have a lot of information, so you can always drill down, and this gave us the move off the lows. They're at about $13, $14, which was the ideal entry point here. On hindsight, draw a simple straight line off this line of that level, and you can see that down the road the market did come here and show multiple support while the RSI was making lows. No, the price was making lows, excuse me. Price was making lows, RSI was improving here, and eventually I don't think you would have had a reason to buy the stock. The reason why I said that is because there is no decisive, obvious, uniform action at this point. So you could have easily have avoided buying the stock here. So yes, sometimes you're going to miss on a couple of points, but remember, you're looking for uniformity, and when you don't see it, the idea is you don't take the trade. This is an example where maybe the trade was not to be taken because the stock did not show nice uniform action during this period. You can say that somebody could have bought this nice sharp support, and yes, it was support at the time. You did not lose money because the stock did move for about 3 weeks, but eventually would go on to make fresh lows. So let's say this: if you see uniformity, you take the trade. You take the trade and place a stop anywhere from 3% to a maximum of 8%, and see how things shake out. So in this video, I've done my best to explain to you that if there is uniform action, the more obvious the uniform action, the better the setup, the more you should take the trade. If there is no uniform action and there is no symmetry and there is none uniformity action, then do not take the trade. Eric Moade, good luck, peace, and blessings. Woo!